Welcome back to the Commodities Dig. I'm Amy Hogan. It appears mining investors are getting even more nervous about gold's long-term upside. We recently saw one of the world's largest gold-backed ETFs, New York's Spider Gold Trust, fall to a 4.5-year low, reporting its biggest weekly outflows in 3 months. Here to discuss the current and future investment state of gold is Robert Cohen, VP and Portfolio Manager at Dynamic Funds. Robert, thank you so much for joining me.
Thanks for having me, Amy.
So recently, Goldman Sachs' Jeffrey Curry was quoted saying in Bloomberg, "Gold is a slam dunk sell for the next year." How do you feel about that?
Well, we'd probably have to wholeheartedly disagree.
Okay.
I think what a lot of investors miss is that gold really is driven largely by its monetary asset characteristics. We tend to always measure the value of gold in dollars, but no one ever does the opposite. They never measure the value of a dollar in gold.
Right.
Unfortunately, we are always led to believe, dollars per ounce, the dollar stays steady and gold is what is fluctuating. It is hard for people to think about the inverse, ounces per dollar, that, gold is actually quite, true to its history, that it's the steady monetary asset and its paper currencies that fluctuate around the gold price. So when we see a weak gold price, it's the same thing as saying we're going through a period of a strong dollar.
So we just witnessed a temporary reprieve on the U.S. budget impasse. Do you see this as the new normal, kind of crashing from one budget to another? And if so, what would the knock-on effect be for mining?
Well, I think with just what's going on with budget deficits, we're seeing inflation in the world, again through weakening currencies. So I'm sure we're going to see a lot more frequent budget hitting those budget ceilings, and the Senate and Congress trying to resolve their issues. But ultimately, that the world is going to have to accept that there is more inflation than meets the eye.
Why didn't we see, with all this chaos in the U.S., why didn't we see a massive surge in the price of gold?
That's $1 million question. And I was actually joking around with somebody today, but there is some truth to my humor. I figured, well, if the government was shut down, they were in fact saving money. So less money, printing of money was necessary. Now that the government's reopening, the gold price just surged today, therefore it implies more further printing of money. But basically it's probably that kind of thought process, but it's very hard to calculate exactly what the market's thinking, because had gold gone up before and then down today, I probably could have come up with an equally smart explanation.
So you and I actually were both at the Denver Gold Forum recently, and just to go back to your previous comment around costs, and depending on where the price of gold is, it influences other things for mining executives. Now, one of the it was actually the main key theme at the Denver Gold Forum was cost management programs. And it seems like every mining executive had a different title for it, but they were all focusing on their cost management programs. Did you think that mining companies were being realistic?
I think they were being reactive to the environment. It's unfortunate they weren't more proactive in a better environment ahead of time. Some of the mistakes that mining companies make include one of the major mistakes is they adjust their cutoff grade once they have their mine plan. So gold price goes up. Some material that was previously classified as waste, we can eke a profit out of it. Let's now classify it as ore, and they adjust the cutoff grades. What adjusting the cutoff grade does is it actually hurts your profitability. I think what the market would rather see is the mine plan left alone. If gold goes up and your profit margins expand, let them expand. The only benefit of adjusting your cutoff grade downward is you would effectively extend your mine life. Let's say, assuming that you are filling your plant. Another mistake that the companies also make is they feel that shareholders are demanding dividends.
Yeah.
And quite a few companies are paying dividends, but all the meanwhile, they have taken on more debt.
Okay.
And what people really don't like at the end of the day is, no, I think that we have to get back to the old ways. When companies paid dividends, it was out of excess cash flow.
Right.
We should not see companies going to the bank, effectively going to the bank or to the equity markets, borrowing money, and then filtering it back to shareholders as a dividend.
But is it because, are they doing that because shareholders have been leaving the mining industry and going to invest in other places? So they're kind of like, well, we need these shareholders. What can we do to keep them? We're going to give them a dividend.
That's the mistake, though. They believe that. But I think what companies
And you don't
really,
believe that?
I don't believe that. I think what companies should really be doing is demonstrating that we will pay a dividend, but only when we can truly, truly afford it.
And then the argument would be to shareholders, and that's why you want to invest in this industry.
Yeah,
We're
because
disciplined.
people see companies playing a shell game. You know, I'm borrowing money from the bank and I'm sending it back out the other door to pay my dividends. That can't be a positive economic, sustainable. You know, it's basically a shell game, and this has to stop.
Okay. What about hedging? What are your feelings on hedging? Do you think mining companies should look at that more seriously?
Well, that's a question that the industry gets all the time.
Yeah.
Should we hedge? And I'm a believer that there's a natural ratio of costs. If you look at the long term, for example, the gold to oil ratio, typically you get about 15 barrels of oil per ounce of gold.
Okay.
So right now, as we speak, it's currently around 13 barrels of oil per ounce of gold. So there's been a little bit of loss of purchasing power of oil, but you could probably do the same ratios for chemicals and tires and all kinds of input costs. Maybe the one wild card out there is foreign exchange, which is another thing that companies could hedge separately. That's another issue. But when we talk about hedging, most people think about hedging the actual gold. That's fine as long as you hedge every other cost, which is not realistic. You would have to hedge your oil prices, your input costs, labor costs. That's fine. Therefore, if you're not going to hedge everything, hedge nothing.
Hedge nothing. What do you expect to see in the next year? What do you want to see from mining executives in the next year?
I would like to see kind of a demonstration of going back to first principles. And kind
you
of
don't
back
think
to
they've done that enough?
Not enough.
Not enough.
I think I've seen acquisitions even recently.
So no acquisitions?
Well, no.
Zero.
No. I'd like to see acquisitions, but a much higher threshold on the economics.
Okay.
We've seen some acquisitions that just look very lackluster lately. So we've seen companies acquiring another company, not even including the acquisition cost. The rate of return at today's gold prices on the project might be somewhere between 10 and 15%. I don't think that's a high enough hurdle to cover off what we often see as the cost of capital. Another thing I would like to see in the future is financing more of the gold industry in gold. Why are we banking this industry in dollars? You know, this is a perfect industry to be financed by lenders of gold as physical gold. The gold bullion in itself can actually fluctuate with your capital costs.
Okay.
If you actually look at some of these capex creeps of many projects out there over the last few years that are still in the development phase, if you actually calculate that capex back to ounces of gold, it's actually more steady in ounces of gold. So I would like to see that, even if a company has to create their own gold-linked note to finance themselves rather than traditional equity. Because what are you doing? You're basically borrowing gold from your, whether you create your own gold-linked note from your investors or other group of investors, and you are mining the same commodity that you're paying them back in. So then it boils everything down to technical risk. I think by financing things in gold, it can actually remove a lot of that capex creep that investors also get upset about. But again, capex creep, the same factors that cause the increase in steel prices are the exact same factors that increase the gold price. It's basically the purchasing power of money is in a phase of rapid deterioration.
Well, Robert, you have laid down some very interesting challenges for the mining industry, but we'll have to call it a day for now. Thank you so much for joining me and giving me that great insight. I know in the marketplace it's been crazy and not everything's happened that we would have expected to happen in gold, especially around the possible debt default in the U.S. But again, thank you so much for your insight.
You're very welcome. Thank you.
This has been the Commodities Dig. I'm Amy Hogan. Until next time.